Hey everybody, Jeff Garber, mortgage expert, and in this video I'm going to share with you what Fannie Mae and Freddie Mac have done to what they call their loan level price adjustments. Now, do not worry if you don't understand that. I'm going to explain it and break it all down in this video, but this is important information because it is going to have an impact, in some cases mild to significant, when it comes to what rate a client is going to get on a conventional mortgage. So I apologize for the length of this video. I know it's going to be a little bit longer, but this is really important information. And I hope by making you aware of this, that you'll understand a little bit more about what is going on, how these changes are going to affect lending and the consumers moving forward here. So I'm going to get myself out of the way. And I'm going to start in this PowerPoint. Now, I left my PowerPoint in this mode because I'm going to be jumping around from slide to slide so that I can make my point. What I'm trying to do is take a very complicated subject matter and really make it easy. So here we go. So let's start with the FHFA. The FHFA is the Federal Housing Financing Agency, and they are the governing bodies of Fannie and Freddie, and they are the ones that came up with this new rule with the loan level price adjustments that's happening. Now, a couple ground rules here. Let's not confuse FHA, the Federal Housing Administration, with the FHFA. So FHA mortgages have nothing to do with what I'm talking to you about. And FHA in general has nothing to do with what I'm talking about. We are dealing specifically with the FHFA. So I just want to make sure you don't confuse the two. All right, these changes are going to start with loans sold to Fannie and Freddie starting May 1st. All right, that means lenders can roll out sometime in March or sooner for loans being sold in May. All right, so that means if you get somebody under agreement today and they're going to settle March 30th or April 10th, more than likely, we'll be able to lock that loan under today's loan level pricing adjustments, not the new loan level pricing adjustments. But at some point, all lenders and banks are going to be following the new loan level price adjustments. Now, this is across the board for all lenders and banks and investors who sell to the agencies. The agencies being Fannie Mae and Freddie Mac. Fannie and Freddie are where many of us get our mortgage guidelines and our interest rates from. The other reason I'm making this video is for awareness, because once I get through this, you're going to see that the new loan level pricing adjustments are going to punish good borrowers and they're going to reward borrowers with lower scores. Don't understand that one, but that's exactly what's going to happen. So maybe if enough people petition to politicians and we can get our voices heard, maybe these changes can get changed or delayed. I know that's wishful thinking. At any rate, they're coming. And so far, no changes. So I'm going to let you know exactly what they are. So, well, what is a loan level price adjustment? Well, let's start there. And let's start under our current rules that are in effect now. As many of you know, the interest rate that you get depends on your credit score. And in the current environment, if you have a 740 credit score or higher, you're considered in the best bucket. And the interest rate that you're going to get is going to depend on the loan level pricing adjustment based on the characteristics of your loan. Now, let's stick with the easy one that most people know. 20% down. So an 80% loan to value means you're putting 20% down. So if we follow the grid and your credit score is 740 or higher and you're putting 20% down, Fannie and Freddie have a charge, which they call a loan level pricing adjustment of 0.5%. Now, this charge is already kind of built into the rate sheet. So whatever rate we offer a client today for free is already going to have this charge built in. All right. And that'll make sense to you in a little bit. All right. Now, as an example, let's say somebody's credit score is in the 720 to 739 bucket. Well, you can see now Fannie Mae with somebody with 20% down is going to charge 0.25% more than somebody that's got a 740 or higher. And as you see the credit scores come down lower, okay, the cost is higher that you're going to get hit to get the rate. What does this mean in English? If you have a 700 score and you're putting 20% down, theoretically, if you want the same rate that this person is getting, all right, you're going to have to pay 0.75 points, because I told you that this 0.5 point here is already kind of built into the rate sheet. Had it not be, and just to explain that a little bit more clearly, if somebody has a 740 credit score and they want the absolute best rate today, Fannie's telling you that's going to cost 0.5 point. All right, if they have a 700 credit score, all right, that same rate that the 740 guy is going to get for a half a point, the 700 score's got to pay 1.25 points for. All right, so obviously, as you can see, as credit score goes down, the cost to get the rate goes higher. Now, the way we avoid paying points and charging our consumers is by increasing the rate. Again, I'm going to show you that in a minute. So I don't want this to get too confusing, but the bottom line right here, and all you need to know, is the lower your credit score, the more expensive it is to get the best rate, or we have to increase your rate to absorb that cost. Okay? Now, as you can see, 740 is the best bucket here. Well, starting really soon, look what happens to 740 to 759. It is now the third best bucket. Theoretically, they've added 740 to 759, 760 to 779, 780 or higher. This now means that if you have a 780 or higher, you're going to be eligible for the best rate available. Now, what happens if you have that 740 rate credit score that we just spoke about before? Well, if we slide on over to the 20% down, that now costs 0.875 instead of a half. So Fannie is now charging 0.375% more in rate and cost to get the same rate now, because this 740 borrower is no longer in the best bucket. Let me give you an example. So let's pretend under the current standard that we have a 740 borrower with a debt to income ratio below 40. All right. And I'm also going to show you what it means above 40. I'm going to get to that. We're going to assume a $300,000 loan. Okay. And again, I'm making all of this scenario up. This is not an official rate quote, or is this a rate sheet? Okay. This is an example only. So under current credit guidelines, if we have a borrower with a 740 credit score, regardless of their debt ratio, all right, and 6.25 is the free rate that we can offer them, well, life is good. Now, let's say this same borrower, okay, has a 740 credit score and their debt ratio is below 40, and we have the new guidelines. Well, that same borrower is now going to have to pay a fee of 0.375% in points to get this rate, or we might have to bump the rate up maybe to 6.5 to give the free rate. So this same borrower is probably going to be up 1/8 or 1/4 unless they want to pay points. Now, on a $300,000 loan, those points are $1,125. So you can see with the new loan level pricing adjustment that it's either going to be more expensive for a buyer to get a certain interest rate, or they're going to have to take a higher rate to get there. Now, here's the kicker. All right. A new loan level price adjustment that they've added is debt to income ratios over 40. We never had to worry about debt ratio and interest rate. Not anymore. If we go back to our regular 20% down loan and a debt ratio over 40, look at this. They're going to smack you with another 0.375% cost. So if you take this 0.375% and your 740 credit score, add it to the 0.375% that we are higher here, all right, and we come back to my nifty little chart, all right, it now is going to cost this same borrower 0.75 of a point, 0.75 of a point more in fee to get the same rate, or we might have to bump it up even higher to 6.75. So let me repeat that. Under today's current loan level pricing adjustments, if a borrower has a 740 credit score or higher, and it doesn't matter what their debt to income ratio is, as long as they're at 50 or below to qualify for a conventional mortgage, and 6.25 is the free rate today, that's what the client would get. Under the new rule, the same borrower, if their debt ratio is 40 or below, is now going to either have to pay 0.375% in points, or they're going to have to take a higher rate. All right. If their debt ratio happens to be over 40, well, now they're going to have to pay 0.75 of a point to get the same rate, or we're going to have to bump the rate up accordingly to absorb that cost. And in my example here, theoretically, that rate could end up going up to around 6.75. All right. This is not good news. Now, do you want to get even angrier? All right, well, let me show you this chart. This is basically called a heat chart, and it's basically showing you, get this, they are actually punishing borrowers that have decent credit. All right, anywhere in dark red means it actually costs more. All the red and orange means it costs actually more than it did under the loan level adjustment pricing that we have now. But get this, look what happens at the lower credit score buckets. All right, they have lower loan level pricing. I mean, anywhere where you see green here, that means that actually they're being charged less to get a rate than they were under the old guidelines, i.e., if somebody has a 660 to 679 under the new guidelines, they're not going to be charged as much to get a better rate. But we're going to punish the 740 to 759 bucket. Okay, doesn't make sense to me. Now, we can break this down all day long. There are several other examples. For example, what if you had in today's world a 740 credit score, okay, but they're putting 5% down, okay? Well, you can see that if they put 20% down, it's actually a little bit better if they're putting 5% down under today's loan level pricing. Believe it or not, you get a little bit better of a rate for putting less money down. I don't understand that one, but that's how it is currently. If we look at the new loan level pricing adjustment for the 740 credit borrower, it's 0.875 for the 80% and a slight reward now. Okay, they've reduced it a little bit. All right, so there is still a little bit of a reward to put more money down, but not as bad. Now, granted, if somebody's 780 or higher and they're putting 20% down, well, they're going to do a little bit better than if it was today's guidelines, because today's guideline, 740, it costs a half a point. 780 is going to cost 0.375, so an eighth better. All right, so again, the 780 plus gets rewarded a little bit. The 760 to 779 going to pay more than you're paying today. The 740, again, going to get paid more, and then you can clearly see the price to get that rate goes up from there. And I can keep going. Second homes, there's going to be a big charge. Look at that, 3.375, basically the same as an investment property now. Second home pricing. So those hits and rates are going to be the same. And for a regular rate and term refinance, there's even going to be a hit to that, which I didn't put on here. But what I wanted to share with you, and the point I was trying to get across, is starting soon, people are going to have a higher rate because of the new loan level pricing adjustments. I don't think this makes a lot of sense. We're already in a low inventory market. I don't understand why the agencies would do this. Greed or whatnot. It's kind of a monopoly, but this is what's coming as of the date of this recording, February 17th. We're hoping that some of the awareness here will allow possibly somebody to petition this and maybe get them to change this or delay this or reverse this. Again, that's wishful thinking, but this is what's coming, and I wanted to share it with you. If you have any questions, I would be happy to answer them. I know that what I showed you is a little bit complicated and confusing, but I'm hoping that you understood the gist of this. And just to summarize one last time, basically 740 is no longer the best bucket. 740 to 759 is now the third tier down in the credit bucket, which means you're going to have a higher rate. All right, 780 plus is your new norm. And the other big thing you need to remember is debt to income ratio is now going to factor in to a person's interest rate on a conventional mortgage. And that's big. That's going to make some changes that are definitely not friendly and not wanted or even needed. So I hope this video was helpful. Please reach out to me with any questions, and I will catch up with you in my next video.